Thank you for having me here. This is a joint work with Shayun Yu. And there are two keywords that I want to highlight in introducing the paper. One is adapting to change, two is short horizon investor. So in general, I'm getting interested, and I hope this is part of a broader research project, on how companies respond to large shocks. And somewhat surprisingly, there is a small growing literature in corporate finance, in economics actually, in which people like David Autor, Nick Bloom have been analyzing how companies react to trade shocks and imports from China. They have been highlighting the average effects. So it's unsurprising that if cheap import arrive from China, companies cut employment in the United States. Nick Bloom has been showing that companies on average try to do more innovation. What I find surprising, and I think is an interesting topic for research in corporate governance, is that we don't know much about cross-sectional differences across companies. That is, ownership structure, governance structure that allow companies to react and adapt to the new environment in a faster, efficient way. So what we try to do in this paper is to use a setup that is more or less similar to the one of Nick Bloom and David Autor, but to focus on cross-sectional differences in ownership structure between companies. So what happens when companies start to compete with imports from emerging markets? The kind of ownership characteristics that we explore in this paper is a short horizon investor. So I won't have much time to talk about it, but some investors tend to have much faster turnover in their portfolio. They aim to make money holding their position for a very limited interval of time. They are not stupid, they have organizational structure and funding structure that give them incentives to turn over their portfolio a lot. In equilibrium, in a market in which there are friction, and in a market with intelligent and smart investors that can anticipate other investor action, as shown, for instance, in Jeremy's time paper, we can have inefficient outcome. So on average, and this has been shown also empirically, companies that have more short horizon investors seem to perform worse. What we ask in this paper is if, however, companies with short horizon investors can react faster to radical change, and thanks to their faster reaction, be able to perform better in the long term. So this is the very basic relationship that we will explore in the data. However, I don't want that you leave the room with the feeling that I'm just regressing Y on X. So I want to spend 2 minutes explaining why we think that this is a meaningful relationship. So what do short horizon investors do? Well, if they observe some underperformance, they engage in a financial market run, meaning that they want to sell before some other investors sell, and in order to avoid capital losses. So companies with relatively more short-term investors are subject to sell-off. We argue that the possibility of a sell-off, even if it doesn't occur, and we would expect it not to occur in equilibrium, can provide incentives to manager to restructure more faster their companies. So to your question, why can't long-term investors do this? Well, many long-term investors are index funds. They just cannot sell. Other long-term investors are active investors, like in Julian, Hannes, and Marco paper, and they provide very detailed evidence that their way to affect companies takes years. Okay, so this might not be the most effective mechanism to affect a company when there is a large competitive shock, and being fast might be desirable. Notice that this mechanism that we want to explore in the data is not necessarily at odds with previous literature. Of course, previous literature has highlighted how market friction leads to inefficient short-termism. But for instance, Gustavo Manso and Daniel Ferreira have an RFS paper in which they highlight theoretically that there could be inefficient long-termism. So it makes sense to ask whether there are states of the world in which this may arise in the data. So what are the states of the world that we look at? So we are particularly interested in trade competition from low-income countries, and as several other papers I've already done in the literature, we look at large tariff cuts. That is when a tariff for manufacturing goods imported to the United States are cut by more than 2 standard deviations. I will show you in a final table that any radical change seems to work in the same way. So for instance, we repeat some of our tests looking at the regulation in service industries. So this will be a completely different sample because the tariffs are for manufacturing goods. The regulation is for service industries, but the main thrust of the result goes through. So this is the background. What I will show you in the rest of the presentation is how we test whether ex-ante differences in institutional ownership, and in particular in short-term investors' ownership, translate in differential performance following large tariff cuts. So what our finding in a nutshell? Well, I will provide evidence on performance, but also on mechanism, suggesting that following large increases in competitive pressure due either to tariff cuts or service deregulations, companies with relatively more short-term investors seem to perform better. And of course, we don't have any magic powers, so we cannot randomly allocate short-term institutional ownership. So I will have a set of tests that suggest that short-term institutional owners might benefit companies in these states of the world. So the data that we use are totally standard, is CompuStat, 13F, and so on. So let me move on. Let me tell 2 words on the measure of short-term institutional ownership. So we use 2 alternative firm-level measures. One is just based on the proportion of investors that Bouchy identify as transient investors. And these are investors that have a highly diversified portfolio and that turn over their portfolio a lot. Okay, so by these characteristics, these investors are not going to have any inside information. They just sell if something goes wrong. And in these states of the world in which there are increases in competition, this might work well. As a robustness, we use a second measure of short-term institutional ownership that just uses a continuous information in investor portfolio turnover. So we just average the portfolio turnover of the institutional investors in a company. So this second measure we will refer to as a churn ratio. So this is our very simple empirical approach. So we have some measure of firm performance, and then we look at what happens in the year following the tariff cut for companies that had ex-ante different extent of institutional ownership. I'll try to saturate the equation with fixed effects, but notice that just an argument on the basis of which institutional investors select different companies cannot bias my finding. Why? Well, if institutional investors just select a high growth company, this should be captured by this term. So my coefficient is going to be biased if institutional investors are different able at selecting companies after the particular shocks that I am looking at. Of course, I cannot exclude that, but I will try to provide as much evidence I can to sort of decrease the concern of this alternative explanation. So we start looking at the impact of the tariff cut on companies with different ownership structure. So what happens to their sales, employment, investment. But after all, we know from previous literature that companies with short-term investors are good at window dressing. So it could be that some companies prop up their sales in the aftermath of the tariff cut, but that nevertheless, in the long term, they have worse performance. So for this reason, we also look at the firm's long-term performance. That is, we look at the average performance of the companies 5 years following the tariff cut. And we check whether their valuation and where profitability is indeed higher as our hypothesis that short-term institutional ownership may be beneficial might imply. And then we will look at the mechanism because, again, I will have some specific tests to look into selection. But as Aaron was pointing out before, trying to evaluate the empirical implication of the causal hypothesis might be the most convincing way to show causality. So this is basically the first initial result. So what do you see here is that following the tariff cut, companies with one standard deviation higher short-term institutional ownership have a drop in growth of sales that is about 2.3 percentage point lower. So this cannot be due to industry performance, as my results are robust when I absorb industry time fixed effects and I can put firm fixed effect and so on. The result is very robust. If I look at employment, investment, I get a very similar result. So let me start trying to test the mechanism. So why would a manager care about sell-offs by institutional investors? Well, a manager would care if he cares about the stock prices. That is, if the stock price of the company has a negative effect on managerial wealth. So if this is what we would expect, then we should observe that the effect of short-term institutional ownership following the tariff cuts are larger for companies in which the CEO has a higher sensitivity of wealth to the stock prices. This is precisely what we explore here. And what you see here is that this triple interaction term is always positive and significant. That is, our effect on short-term institutional ownership are concentrated among companies for which we would expect the CEO to care about temporary drops in the stock price. So then we look at the long-term effect. That is, it could be the CEO is just propping up sales to window dress. Is this what we observe in the data? And the answer is not. Even if, so on average, the Tobin Q and the profitability of companies with more short-term investors are larger even 5 years after the tariff cap. And the effect is meaningful in the sense that one standard deviation increase in the proportion of short-term investors increases the Tobin Q by 6.3 percentage points. And the effect on the ROA is more or less consistent. Then we look at the mechanism. So if companies achieve higher sales, higher valuations, how do they do that? So how would you react to competition? Well, what we find in the data is that this company try to change their operation. So for instance, we see that the companies with relatively more short-term investors increase their advertising expenses following the tariff cuts. Using data by Hoberg and Phillips, we find that their product become temporarily more differentiated than the ones of the competitors. That is, if you take an industry that has experienced the tariff cuts, the companies with relatively more short-term investors in that industry have a product that overlaps less with the product of other listed companies in the US. We also find that this company try to change their product by entering in new markets, meaning that they don't do necessarily more merger and acquisition, but they do more diversifying acquisition, which is consistent with our results that they try to change. We also find that there is more executive turnover in companies with more short-term investors following the tariff cuts. So all of these evidence supports the ideas that, well, this company perform better if they have more short-term investors, and they do so by attempting to change their business model. So I do have all the results, but in the interest of time, I want to talk in my last 10 minutes about the robustness of the result. So first of all, what is the first concern? Well, we are trying to implement the empirical analysis as a sort of difference in difference empirical model in which, well, there is a shock, the tariff cut, and in which we are using short-term institutional ownership as a difference in exposure to the shock. So the first concern to address is, well, what perhaps there are pre-existing trends that such that institutional investors have selected the companies within an industry that already performed better. So we run a placebo test, and I show you the placebo test. So basically, the blue interaction term is my effect, and then we look at how the companies that have a relatively more short-term investor perform in the 3 years preceding the tariff cut. And what you see is that there is no better performance for these companies during these previous 3 years, suggesting that, well, a pre-existing trend is relatively unlikely. So what else do we do? Endogeneity of institutional ownership. So what can we do here? So remember, the main problem, the elephant in the room, is that, well, institutional investor job is to select companies that are going to be performing better. And it's not something that is completely out of this world, that the institutional investors put increase the resources that they put in this job when there is some large industry shock. So how do we try to identify that our results are not driven by selection effect? Well, one very pedestrian way, but in my opinion effective, is just saying, well, let's just look at short-term institutional ownership 4 years before the tariff cut. At that point, it might have been hard to, one, forecast the tariff cut, and second, forecast which companies were in a situation to be able to face the increase in competition. So, of course, these are short-term investors. They do not hold the companies for 4 years. But basically, these short-term investors hold liquid companies because they trade with each other. So the identity of the short-term investors, without any doubt, changed during the 4 years, but not the extent to which these companies are held by short-term investors. This is something that we can check in the data, and the correlation remains at some 80%. So if we use a 4-year lag for the extent of short-term institutional ownership, so what do you see is that, well, our result is completely robust. Second, since we are in a theme of index inclusions, and since this instrument is popular, as many others, we also look at Russell 2000 inclusion. And we implement the instrument similarly to Brun and White 2015, simply because they show that on average, short-term institutional ownership increases after the inclusion in the Russell 2000. So our result is robust, but of course, there is a lot of other characteristics of institutional ownership that are changing around these inclusions. So for this reason, it's very important to test for this alternative mechanism and other changes in the type of institutional owners. So if you let me go to the relevant table, which is here. So what do we do? Well, we are concerned that besides short-term investors, there are, well, index funds or long-term active investors that Bouchy calls dedicated investors that are varying their holdings. So all of our results that I've shown you so far are obtained controlling for the extent of institutional ownership. We also look at the differential effect of companies with different institutional ownership following the tariff cut. But then we look at this in a more precise way. So what we do is that, well, we might be picking that not much of the effect of short-term investors, but the fact that companies with more short-term investors also have more dedicated investors that engage in the kind of activism that in Julian, Hannes, and Marco's paper. But following tariff cuts, we basically find no effect of this type of activism. Another possibility is, and here we don't have Alon data, but we have Alex and Vivian data, is that, well, it could be that these short-term investors favor investor activism. So we control for the effect of investor activism. There are very few, but we don't find anything. We have a much more robustness in the paper. The effects are basically robust, that if instead of tariff cuts, I look at the regulation. So let me sum up. I think that is an important topic to try to understand how companies react to shock. So because it's also a way for us studying corporate governance to have an impact. And what we propose in this paper is that, well, long term is not always good, short term is not always bad, and that sometimes when a company are subject to competitive threat, to push a company to change fast might be desirable. So what the paper would suggest is that perhaps all this policy debate about short-term investors is misplaced, and that, well, more short-term investors might be perhaps a good antidote to zombie companies. Thank you.
So thanks very much, and thanks to the conference organizers for having me. What a gorgeous spot to have it, and the weather's just incredible. I'll try and keep my discussion somewhat short since it's the end of a long conference. So basically, I think one of the classic questions in corporate finance, going back to when Cliff and I were assistant professors together in the 1980s, is does ownership matter, right? And so the usual answer is yes, right? And so the usual reason is that, well, when you have more ownership, especially by long-term block holders, that increases value. Well, why? For there's better incentives for managers to increase value and better incentives for block holders to monitor. And that's kind of the normal story that we argued about for 25 years, and we sort of more or less agreed to it. Now, what? Can you put this on the jacket, please? Oh, I'm sorry. This up here. Can you hear me now? Better? Okay, so the Giannetti and you, they come up with a different answer. They come up with the same answer, but a completely different logic, right? So their answer is yes, it does matter, but their reason is completely different. The reason is that short-term shareholders, because they will sell if they are unhappy, well, they will encourage managers to make better decisions. And so, what the paper does, as you just heard, is it considers shocks to companies coming through changes in tariffs, and it looks at the way the firms respond to these tariffs. And basically the main finding, and I am not going to go through the nitty-gritty of all the results that you just heard, but basically the main finding is that firms with short-term shareholders respond more effectively than firms with longer-term shareholders. And so to me, this sort of turns the literature on its head, right? So basically, previously the literature had kind of thought that concentration was the big thing, and we didn't talk about the horizon so much. But basically, I think the longer-term shareholders tend to be the ones who are in larger blocks, so that we think of the owners that have been there for a long time, they tend to be concentrated. And the literature really has focused more on the concentration than the horizon of the shareholders. And I'm not saying that's correct, I'm just saying that's just what we've talked about. So maybe Maria Sunta and Xiaoyun have sort of we've got it completely backwards. And so this paper argues otherwise. It says that there are advantages of short-term shareholders as well. And so basically, I think the issue this paper raises is whether horizon or concentration, or perhaps both, are the right things to look at. And so basically this paper focuses on the horizon of the investors. And the prior literature, there's a gigantic literature, so I don't want to say all of it, but the most of it focuses on the concentration of the investors. And the two, again, as I said, are related. Block holders, they tend to be long-term investors, but they're not always long-term investors. And so as I read this, I sort of kept on saying, does the empirics control for this enough? And I don't know the answer to that question, but that seems to be the central question in the paper, as opposed to the endogeneity of the shareholders. And how about the other thing is how about the identity of the investor? So much of the literature has focused on whether certain kinds of shareholders, and Julian's papers have done that, have looked at whether individual investors are different from institutional investors, right? That seems like a pretty important question. And again, it's probably the case that some of these are more likely to be classified, I forget exactly how you classified them, but as short-term or long-term, but there's lots of dimensions on which these shareholders are different. And moreover, theoretically, which should be important and under which circumstances, again, it's not obvious to me. I mean, she tells a story from one of Slava's papers where, that maybe short-term investors are better when there's a negative shock and they have to respond. and so the threat of them all pulling out and causing a run is bad. I don't know. I don't know how the horizon will affect the actions of shareholders in normal times when there's not a big shock. And so, and again, the empirical design is sort of focused around these tariff cuts. And I think the issue that the paper is raising is much bigger than that, right? If the horizon of the investors is really important, then we should care about much more than how they respond to tariff cuts. And so I guess I was a little puzzled as to why this was the right thing to look at. And so it's plausible, at least to me, that the logic could work in good times and in average times just as well. And so what happens if you just kind of rerun the old Mork-Schleifer-Vishny regression that using horizon rather than concentration, and most of you have seen this before, but just basically Q is equal to some function of ownership, and to sort of see how the ownership varies. And the ownership is typically, again, measured in terms of the concentration, but there's no reason why it couldn't be measured in terms of the horizon. And so the more general question is, how does the horizon of investors affect investors' actions and also the actions of the firm's managers? And I don't claim to have the answer, but I'm saying that that's sort of, as a discussant, I can ask questions without answering it. It's my prerogative. And so that's kind of the issue. And so basically, has the literature on ownership and performance been looking at the wrong thing? Again, I don't know, but if they have, then I certainly think you should be saying that in the paper. And if they haven't, then you should be saying that in the paper too. Another paper, international considerations. Well, this has to be the most international paper of all. We have an Italian co-author and a Chinese co-author. One of whom is working in Sweden, presented in Jerusalem. So what they use American data, right? So I don't know. To me, I don't know why. I'm an American, right? So I kind of think that these issues are sort of equally important and perhaps more interesting in other countries in the U.S. And a good Korean friend just told me, like in Korea, they don't. If you don't have a large block holder who owns 20%, who's there forever, then nothing gets done, and the company's completely non-functional because of Korean culture or something. I do not know this, but this is a Korean corporate finance professor who does know. Endogeneity, okay, and I did not make up this slide, 5 minutes ago, given the discussion all day. But so one of the things that Miriam has once told me that she used the words obsession to describe the endogeneity, and certainly, and that slide was written before the discussion today, and before Bernie's little speeches, and I basically have argued elsewhere that governance is endogenous in an important way, and the boards are endogenous. I mean, that being said, I think for the purposes of this paper, it's not that big a deal, right? Basically, the shareholders are who they are. Nobody knows the tariff cuts are going to come up or anything like that. And so the question, to me, the paper should be focusing on is, what the results mean. To what extent are they driven by the horizon or some other aspect of these shareholders, which I don't really know. And that kind of explains the results. So overall, it's a very provocative idea and results. How does the horizon of the shareholders affect their actions and management's responses? And I think the paper should spend more time trying to distinguish the effect of horizon from concentration. And so, in other words, I think what Mary Isabel sort of said at the end, which I could sort of summarize here in the last point, is that the short-term shareholders matter when firms receive negative shocks, but long terms might add more value at other times. I don't know. That's like an empirical issue, but it seems like a pretty important one. But I think if you're if that's what you believe, then why not state it in the paper and do kind of a more general test of it? Maybe that's not the paper you want to write, but anyway, those are my thoughts. So anyway, thanks again for having me. It was a real terrific time being here, and that's it. So,
thank you very much.
let me take this with me.
Would you like to respond or collect a few questions?
Yeah, I can briefly respond. So thanks a lot for the comment, Mike. I agree that here endogeneity is not the answer. On ownership concentration, we can of course discuss it more. We do two types of tests. We look at the concentration of institutional ownership and control. And we also look at the concentration of family block holders in a bit coarser way because of data. And our results do not seem to be driven by that. Now, just taking a step back, yes, we are a bit agnostic on the average effect of long-term investors, we rely on previous literature that seems to find that on average short-termism is bad, but we want to highlight that in some situations the short-termism may actually favor change and be good for the company. But perhaps we could be more explicit.
Well, let's go on Slava, please.
Just one question.
Maybe the microphone.
Yes. So, yes, just a question about one possible interpretation. Is it possible that there is some kind of matching between type of firms and type of institutions in the sense that fast responders on corporate side match with fast responders in terms of making investment decisions? So these types match, right? People who move slowly and think carefully like talking to people who move slowly and think carefully, right? So can you look at other incidences, not only tariff shocks? Is it always the case that you see firms with investment firms that have high turnover, these firms respond fast? It's still, again, I think result is valid, just what it means.
I think the mechanism you're highlighting is exit, right? Governance for exit, Alex and Adante before. So
It's a bit different.
it's well,
Yeah.
that's at least was my understanding.
Yeah.
And exit works in both of these models and the other models, including Slava, only if the investors have some private information. And because by selling, they depress the price, and managers hate low prices, therefore they're trying to preempt that actually, by doing the right thing. So I think, for me at least, to be really convinced that's the mechanism in play, maybe it's something else, that's fine, but if that's the mechanism in play, there should be some evidence consistent with that these investors actually generate some price impact, or they have some private information. And I would just note that you seem that you are describing pretty radical changes into the industry. So I think it might be even more difficult to argue that these kind of investors have some private information in this stage where it seems everyone understands.
Yeah. So actually, I think that this is a very important point, and partially I forgot to tell. So it is so the mechanism of Anatamati of Alex based on exit is exit of blockholders. So that yes, they are expected to have private information. Here it would be foolish to expect that the small diversified investors that trade a lot have private information. So what is going on here? So in our view, this is a different mechanism of exit in which the investors do not have private information, but they trade on order flows, small shocks. But if there is a small shock such that these companies underperform the industry, they just go for a market run. You see a large share price drop, and this has partially been documented in previous literature. Okay. And this is sometimes bad. So sometimes we have inefficient short-termers, but it sometimes may be good. And if you want a similarity, is very similar to the mechanism of short-term maturity in dark diamond models. There, the fact that these investors can run on the firm provides discipline. And this discipline is sometimes an inefficient constraint and sometimes provides right incentives. But I don't view these as relying on private information.
So, yeah, so following up on that, I guess I wasn't clear and I tried to look back at your paper, but I didn't have internet access. You're basing your definition of short-term on turnover, but it seems to me there's sort of a range of short-term investors who are information-based and sort of, high-frequency trader types that are trading based on market conditions. And given your story, I wonder if there are other market conditions that you can look at. I mean, does bid-ask spread increase in light of these kinds of developments? Are there things that would make high-frequency trading trading more profitable, if there's this change in tariffs or something like that. And then the other piece of this is when you talk about the mechanism, you talked about pay performance sensitivity for managers. Are you looking at how short-term the sensitivity is, or are you just looking at the classic measures that look at, overall sensitivity that don't distinguish in terms of time frame? Because I would think that would matter too.
I didn't distinguish in terms of time frames, but it's, yeah.
Sorry, this is anyone else? So how about a half-hour coffee break? Most of you have been well behaved. So